In this video, we're going to talk about one of the things I see successful real estate investors do, and that is having multiple exit strategies. Now, a lot of people just think, hey, I just need to buy and hold, or they've just got their mind set on one thing. But I want to tell you that if you want to be very successful and not get stuck and pigeonholed, I would plan on multiple exit strategies. So I'm going to show you what I mean. I'm going to show you some of the things that I've done, what I see other investors doing that have been really great for them. And I'm going to start off with one that's probably my favorite. Now, this is something that I've seen. I've got some friends who do this, and I'm telling you, it's insane what they're doing. So let's go into the first one right here. All right, the first one is owner finance. So they buy a piece of property and they're already thinking, hey, I've got several different things that I can do with this. But what a lot of people that I'm seeing today do is they're just doing owner finance. They're becoming the bank. They're selling that piece of property, and sometimes they're selling it as is without repairing anything. So let's talk about what this looks like. Now, this is when you as the owner, you act as the lender and you're just going to sell the property. So you sell a $250,000 property, 10% interest rate over 30 years. Now you can make up the numbers whatever you want to do. If you didn't want to have a loan out for that long, for maybe for 20 years or 15 years or whatever the case is, it needs to be within reach of the market. So you need to understand your market, see what people can afford. But let me show you what this looks like on in your mind. It's kind of hard to understand. What is $250,000 loaned out over 10% over 30 years? What does that actually yield me? Let's take a look. So here it is. This is one of the calculators I use. You got $250,000. The term is 30 years. Rate's 10%. Monthly payment is going to be $2,193. Monthly interest on that payment is $1,500. Total interest is $539,000. Total amount that you would receive over 30 years, $789,000 over the course of 30 years, because you are the bank. You're taking the risk. You're loaning that money to this person. They're paying you back for that property. Now, let's keep going here. To me, this applies to buyers who typically can't qualify for a traditional mortgage, because most people right now can get a 7% mortgage. 30-year mortgage can be 7%, maybe 15%, 6%. A 15-year at 6%. It just kind of depends where we are when you're watching this, where we are with the interest rates. However, you can charge a little bit higher interest rate because they're higher risk. So the people that are buying this property from you are higher risk. So there should be no expectation to loan money at the same price as you would, as somebody who's well qualified with a 750, 800, credit score can get. So I have seen people do this. I've seen it, like people who there's no way they'd be able to buy a house. They are selling them houses, and they're even doing this. What I actually love about this is they're doing it with any class neighborhood. A, B, C, D. They will buy cheap houses that people want to buy. They can't get a traditional loan, so they'll sell it to them. And in some cases, they're selling it as is. So the people come in, move in the house, and they do all the repairs. Now, what are some other advantages of this? Listen, we manage a lot of property all over the country. We love when people rent houses and we're able to manage them for them. However, one of the things that's attractive about this is you're not responsible for repairs. You're not responsible for anything really. It's ultimately the person who's buying the property. They own it. They're doing the landscaping. They're doing repairs and maintenance. They're paying the taxes. They should be paying the taxes. They're paying the insurance. So think about all the operational expenses that are gone when you do this. That's why this is becoming very, very, very popular. I've even seen where some investors are buying houses pretty cheap or relatively cheap and then selling them to other investors this way. They'll owner finance it to other investors who will fix it up and rent it out. So it's out there. It's possible. this is one of the ways, when I think about exit strategies, when you're buying a house, this is one of the ways that you can look at that. All right, rent to own. Now, this is a great one. I've done this one a couple of times where I had a property and these people wanted to rent, but eventually they didn't want their rent just going to rent. They wanted their rent to eventually pay for the property. And I was like, fine, that's great. Here's a contract. I had a rent to own lease. It was really a rental agreement with with an option to purchase the property after, I think, 24, 36 months, I believe I had it in there. And then one of the things that people do is they put a lump sum down. So they put some money down and then rent it, and a portion of the rent goes to the purchase of the property. And all that's laid out in the contract. I thought it was great. It was a great opportunity for these people. Actually, there were 2 houses side by side that I did this. And this was, I think it might have been 2 years that they were able to then purchase the property. What this does is it gives them the opportunity to build up their credit and purchase the property. Also, by the way, with the other one, with the you become the bank, your owner financing, they can also refinance you out of that if you want, right? So you're selling it at a retail price. And if they improve their credit and find themselves in a different place, they can refinance and get you out of it, just pay you for that property. The same thing happens here. There was an initial deposit. I remember, I think mine was like $2,500 down, I believe, for each one of the houses that were side by side, and they were a little bit cheaper. This was in a C- area, and they were paying around $800 a month. So it just kind of all depends. You can work it out so that it's beneficial for them. And again, a portion of the rent went towards the purchase price. I can't remember how much when I did this. I want to say maybe 10 to 15% of the rent went towards the purchase price. Now, as the rent to own, I was still responsible for repairs and maintenance, those types of things. And in both of my cases, the people ended up not actually purchasing the property. So, but it was a 100% an option. And what they're paying what they're paying at the very beginning is they're paying the option to purchase that property. So that $2,500 was an option to purchase, and I would have applied it to the purchase price. But they ended up not doing that. All right, let's look at another one. Wholesaling. This is another one. If you buy a property, you're looking at a property, you need to be able to think, can I wholesale this thing out? Would I be able to sell it to somebody else, right? If I don't want to own or finance it, if I don't want to rent to own, can I wholesale it out? And if you're wholesaling it out, then you're just assigning that contract for the most part. Now, I know a lot of people get into wholesaling because it requires little to no capital, quick cash profits, right? So if you can put something under contract and then just sell that contract, I've done this a number of times. I started my business wholesaling. Now, it required capital. So we were spending $5,000 a month advertising. And I believe that most really successful wholesalers are spending money advertising. I know several groups who do this, and they spend a lot of money, but they also get a good number of deals based on that, just depending on what they're doing with a lot of them are still doing direct mail. They're doing, AdWords, that type of thing. But what you really want to do is you want to find a distressed property, and maybe not even a distressed property. You want to find a motivated seller. You want to find somebody who is motivated. Now, these are the numbers that work for us. We were getting about 100 people each month that would reach out to us because they knew that we bought houses. We were paying cash for houses. We were buying them. And we got about 100 leads. We would do initial screening right off the bat. And sometimes we would completely disqualify. As a matter of fact, we disqualified a vast majority of our people. Let's just say we disqualified 70 out of the 100. So 70% we disqualified. They owed too much. Maybe it wasn't a property we wanted. I don't know, whatever the case was. And then of the 30%, we made offers. And we only bought 4 or 5%. So we would buy 4 or 5 properties every single month. But those were the numbers because we were looking for the motivated seller. Now, it just so happened that sometimes the motivated seller and the distressed property went hand in hand. But we were buying in A-class neighborhoods as well as D-class neighborhoods. A-class would be the most expensive neighborhoods in your community. D-class would be some of the cheapest where you would find some of the cheapest, maybe the oldest homes in your community. Everybody's motivation is different. This is the crazy thing. When somebody's selling real estate, everybody's motivation is different. We bought houses that it was a class A. It was outdated, and they didn't want to have people parading through their home, selling it on the retail market. I'll never forget, we bought several houses in A class, but I'm thinking about one that was just totally outdated, and they just didn't want to deal with people. That's motivation. It wasn't distressed. Bought another house, wasn't distressed, motivated sellers, inherited the house, didn't want to walk in the house, didn't want to look at it. They literally called us, and we bought the house the next day. We got clean title and bought it the next day. Fastest closing we ever did within 24 hours. You're looking for the motivated people. So how do you find those people? Well, that's a whole different video. We were, again, advertising, spending $5,000 a month, sometimes $7,500 a month. We wanted more leads. But it's a great way to start your business. If you don't have a ton of capital, you can do a lot, what we would call dig leading. You can drive neighborhoods. I've known UPS people, FedEx people who have successfully done this because they're in all these neighborhoods. They drive by the same house with rotten wood peeling paint all the time, and so it was easy for them. Anyway, wholesaling is a good way. So I've just gone over 3 different ways that you can look and say, hey, I can use this property for one of these 3: owner finance, rent to own, or wholesale it out. Next, maybe you could sell it on the retail market. I've seen people do this. I've seen buy a distressed property or buy a property that's just kind of outdated. So I'm just thinking of the A-class one that we bought. We didn't touch it, and we sold it to another investor who then went and sold it on the retail market. We could have sold that on the retail market. As a matter of fact, all we really had to do was probably clean it up. It was definitely 70s. We could have cleaned it up and then sold it. We could have 100% sold it. And now it wouldn't have gone as high as the best houses in that neighborhood were selling for, but it would have maybe had a little discount, but we still could have sold it on the retail market. Somebody would have bought that and moved into that house. We just didn't want to mess with it. But you can. This could be another strategy. Hey, if I don't think it's a great rental, I've done this before. I have bought a house. I remember I had sold it to a friend of mine. He came to me a week before closing or whatever and said, hey, I can't do this. I can't buy this property, or I'm going to have to pay you less. I said, no, I'm not going to take less. I'll just hold on to it. I'll sell it on the retail market. I tried to sell it on the retail market, couldn't sell it on the retail market. So what did I end up doing? I went a different direction with it. But you can do any one of these things. That's the thing. The whole point is you should be able to buy these properties and have kind of some leeway with what you do. I think selling on the retail is great, even if it needs a little work. There's something called wholetailing, I think is what it's called. Wholetailing, which is a mix between wholesaling and retailing. It's wholetailing. So it's maybe the house isn't in the perfect shape, but they just clean it up a little bit and sell it as is. Put it on the market, see who wants to buy it. And you can do that. So no need to manage residents or handle maintenance. You just get it. Now, when you sell it on the retail market, if you are doing work to this property, it's probably going to be more work than what you would do if you were just going to rent the property. You're going to probably spend another 20-30% getting the kitchen right, the bathroom right, making sure that the fixtures are the right, fixtures. Maybe you're gonna have to repaint the exterior of the house, interior of the house, whatever the case is. So you need to factor that in. You're gonna spend more money. Don't think you're gonna upgrade a property rental spec and sell that on the retail market. It'll sit there for a long, long time. And then what you're gonna have to do is you're gonna have to bring that price down. You're gonna have to take a discount based on the work that you did, which wasn't great. So, all right. Best for high demand markets. I love these class A and class B neighborhoods, like the upper middle class and the upper class neighborhoods. This works great. Next, house hacking. Well, maybe you can do I've mentioned my niece before. She'd just done a house hacking. She bought this property, wasn't expecting to turn into an investment property, but that's exactly what it is now. It's an investment property. And so she's got the basement rented all out and she's paying for her mortgage. That's one way you can do it. I know people who buy duplexes. They already have in their mind, this is what we're going to do. We're going to house hack our first 4 properties, and we're just going to move. And whether you're doing this by yourself or you're doing this with your partner, whatever the case is, You can do this and upgrade every single time, and it can work. So you live in one part of the property, you rent out the other. Just think if you had a $1,500 mortgage and you reduced it to $300 because somebody was paying you $1,200 to live in one side of it. Perfect. You build equity, earn income. You're paying down your mortgage. The price is increasing, so you're getting some appreciation. And then when you go to sell it, you can sell it with a resident in there, and it's going to be incredibly attractive for somebody, for an investor who also wants to house hack. Great for first-time home buyers or small investors looking for a low-risk way to start. I think that's absolutely true. I've known several people who that's how they started, was in doing this house hacking the very first thing. Short-term rental is another option, right? So if you're this is the crazy thing. I have a friend who had 100 rental properties in our city. They were all in Class C areas, so working class areas, not the best areas. He started turning these things into short-term rentals. They had been long-term rentals for a long time. He just started taking select ones and turning them into short-term rentals, and it's worked out great for him. But this is the key. This is probably the biggest change he said that he had to make mentally, going from long-term to short-term, is that he is now in the hospitality business. Everything depends on the people's experience, the reviews they leave you. So this hospitality, obviously you're going to have quick turns. You're going to have to furnish the place, but you live and die on those reviews. Period. The end. You're either going to have more business or no business based on the returns. Like even when I just booked a place for my family not long ago, and I was looking at reviews, and I'm looking for the most reviews. I'm not really looking for ones that had 3.9 or 4.4. I want 4.98 or 4.99 or 5 stars if I'm thinking about Airbnb, and that's where I rented it. So high income potential, nightly or weekly basis, $200 per month. What if you just rented it for 15 nights? It generates $3,000 a month. If you had a $200 per night place, $3,000 a month. Versus what if you probably rented that long term for $1,500 a month? So 15 nights, half the nights, double the income. Hey, not a bad idea. They can generate 30 to 50% more than long-term rentals. Use property for personal stays if if that's something that you wanted to do. I know people who do that. This is the challenge: guest management, local regulations, what's going on in the local market. This was super hot in Nashville in the very beginning, and then all of a sudden in Nashville just started. The city started shutting all this stuff down. So the people who bought in early, who bought condos, because they were building a ton of condos back 10 years ago, when they started doing this, man, they got grandfathered in, and they were able to have their licenses, and it's incredible. The real estate there has been phenomenal. All right, what's another one? You can rent the property. This is what we're all about. We help people manage their rental property. We manage rental property for investors who buy it and then they just want to rent it, and then they want to focus on other high return activities like finding more properties. So generate steady monthly cash flow. While I do like to tell people it's a business, you're buying a business. When you buy a rental house, it's a business. It's a lot less involved of a business than short-term rentals. It's less involved. If you get a good resident in, honestly, a good resident doesn't want to hear from you too often. They just want to pay the rent and you leave them alone. So what are the things that you're going to have to do? You're going to have to communicate are things like, hey, any kind of preventative maintenance checks. If you go in there and do an inspection, those types of things. You're going to have to communicate when, there's a freeze coming. Hey, just want to let you know if you leave the house, there's a freeze warning coming. There's all kind of things that you're going to have to communicate. However, it's a lot lower than dealing with new people coming in and out of that house all the time and paying cleaners and replacing furniture and stuff like that. Why people love it is because it's best for long-term wealth building. It's just long-term wealth building. As a matter of fact, I just saw a recent study that was talking about the the number one way that people think about building wealth over the long term, more than stocks, it's real estate. And they went through all people who make under 30,000, people who make 30 to 100,000, and people that make 100 and above. All of them said real estate was better than stocks. And this is the mentality, is that people want to own real estate. It's typically a hedge against inflation. When prices and things go up, well, guess what? Rents go up as well. So renting the property is a really good avenue. And if you don't have anybody, if you are doing this or you want to do this and you don't have anybody, reach out to us. We manage property all over the country. We would love to help you out. We would love to let you know how much the property can rent for, all those good things. So this is it. Overview. Diversify your strategies. I think really successful and savvy real estate investors have different exit strategies. When they're buying a piece of property, they're thinking, hey, what else could I do with it? Think about that. So I think it's really, really good. Run the numbers, figure out what you're going to do. I think staying flexible is really key. Look at this person. He's or she is stretching and they're getting really good and limber. Stay flexible out there. And if you like this video, go ahead and subscribe to our channel, like the video, and then we'll be back with more real estate investor videos just like this one.